Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by a Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with a Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space. All right, we're back for another episode of the Mortgage Broker Podcast, and today we are continuing on with our Behind the Lender series, and very excited and appreciative to have Alex Dey of Scotiabank, VP Portfolio Optimization. This is going to be a little bit different because we're going to go behind the scenes more so on the origination of Mortgage Plus, which has been a big piece of our business in the last 18 months, or coming up on 24 months now, and just who Alex Dey is, and a really cool piece on pricing. And I found very educational when you presented to us in Quebec City. So Alex, welcome to the show and thanks for being here.
Yeah, great. Thanks, Dean. Thanks, Jason. Thanks for having me.
Yeah.
Looking forward to it.
So maybe just a quick introduction to yourself, what you do at the bank day in, day out, and, bit about your history, and we'll jump right in.
Yeah, I'm the VP of Portfolio Optimization and been with the bank for 22 years. Did some different jobs before I came to mortgages. I came to mortgages 11 years ago, so bit of a veteran as it goes in the bank. Love the business. Portfolio optimization, people ask me, what does that mean? So it really has to do with the overall health of the portfolio.
Yeah.
Right, and that's growth of the portfolio, right, within our expectations, profitability, obviously, staying within our risk appetite, and effective capital management, which I'll talk more about, but that's become, an even bigger theme these days.
How do you find your role bridges strategy with the economics and broker engagement? Like, where does the broker engagement start to come into your strategy?
Yeah, I think the strategy of the bank is become more and more about customer primacy. I think all banks are looking for that same thing, as developing a deep relationship with their customers. And, the way that the mortgage business fits into that is it's a really big source of new customers for the bank, right? And so, we call it an anchor product, right? Because, people who need a mortgage, and it's a big part of everybody's financial life, and so, if they come to the bank through the mortgage, we can grow that customer relationship, into hopefully a lifelong primary bank relationship. So that's kind of the strategy and how mortgages fits in. And then brokers, brokers deal with a lot of first-time home buyers, a lot of first mortgage people. By the way, almost half of consumers, right, go to mortgage brokers. Yeah. So if you're not in the mortgage broker channel, how are you serving almost half the market?
Yeah, that's a good point.
We really believe in being in all the channels. We believe in being, wherever the customer wants to do business, right? And so that could be obviously branch advisors. It could be a direct sales mortgage specialist. It could be digital. We have digital. We have our e-home, but we also have broker. The broker business is a huge part of our business. So, that's how it fits in. It brings us a lot of new customers to the bank, and those customers very often, become primary customers.
What excites you, if anything, about the broker channel and just how it's evolving?
Yeah, I think I talked about, surveys happen, and, every time a survey is done, you get that high incidence of customer preference for brokers, right? It's usually somewhere between 40 and 50% every time somebody does a survey like this. And so for that reason alone, being in that channel is important to us, because that's where almost half of Canadians are going to get their mortgage, right? And mortgages are complex, right? So customers are looking for that expert advisor that can help them get through what's a very complex and stressful aspect of their financial life, and brokers are filling that need, and that's not going to change. Things are just getting more and more complex, and so, we think that brokers are always going to be a huge portion of Canadians' mortgage, channel of choice. And we love our SMA model. We think we've got a great model that's difficult to duplicate out there, and we really believe in the relationship, between the bank and the broker, and it's continuing to keep us in a great competitive stance in the market.
I couldn't agree more, just from, the complexities and how this business has just evolved over the last few years. And I think more and more, even as we kind of become more disconnected from the human element of it with AI and all of that stuff, I think clients being able to talk to a broker and really have that human to human contact and walk them through transactions from front to back, no matter what state they're in. I think the broker market is just going to continue, and those professionals that are engaged with the clients and building that relationship, and of course working those relationships with SMA and Scotiabank. And I think that's the direction that we're going now, is that human element in that broker level is going to be paramount going forward.
So true.
Couldn't agree more. So just kind of moving on to the Mortgage Plus, because it's been a big part of our business, and you mentioned relationships. Scotiabank in particular has been a solid 40% of my personal production over 12 years, and then going into running our brokerage, it continues to be about 38 to 40% of our volume. So it's obviously a very important partnership and relationship in our eyes, but also just across the mortgage broker channel. I get that similar feedback from almost every broker I speak to, and it speaks to the service you provide. It is unique. We have very deep relationships with key components, whether it's BRMs, RVPs, people like yourself. We feel like the top-down support is there in a big way. And, you've set the standard, in my opinion. Some other lenders are starting to catch up, especially on the alternative side. We're starting to see more of that top-down support. But one thing that really stuck out to me was just the origin of Mortgage Plus and just how we were engaged as part of that on an SMA trip. Maybe just we can kind of get into that, just a strategy around that, and ultimately why it's a big part of the bank's capital efficiency.
Yeah, great story. I mean, Mortgage Plus has been a huge success for us. And, if we look back to the beginning, it was capital. The evolution of capital is really what is underpinning it. And, more and more with the regulatory environment and how it's evolving, capital for banks is becoming more and more precious. The need to be strategic about how you deploy that capital when there's only a finite amount of it. When you think about all the different, sources of lending and different places to deploy capital. And so in that backdrop, when you look at mortgages, the margins are thin relative to other, other lending products that the banks have. And so when you look at a thin margin product, which is consuming capital, and you do that return calculation, the capital requirement is becoming more and more. That equation starts to, break down if you just look at the mortgage. So the need to bring in more customer value to kind of bolster the equation, that return equation, right? And have that deeper relationship so that you've got more customer value for that similar amount of capital. Now you start to get that equation working in your favor. So that was the genesis of where Mortgage Plus came from. We needed to have deeper relationships right from the get-go, right coming in the door. That's where the idea for Mortgage Plus came from, to have additional products alongside the mortgage at the point of origination. We designed something that we felt was the right balance between giving us what we needed in terms of customer depth, but not being too much. Yeah. So that it became, a big friction point in the mortgage origination process. So that was the balance that we were trying to strike. And, the day-to-day bank account obviously is crucial, foundation for any long-term customer relationship. So that became mandatory. But beyond that, we just asked for one more product, right? And, we don't decide what that should be. I mean, that's for the customer to decide. And so that was the idea of it. If you look back at that time, we had stepped back from the market. We came up with this idea. And then, you mentioned the trip.
Yeah.
In the Austin broker trip in 2023, we had hatched up this new idea. We didn't have a name for it at that time, called it a bundle or something like that. But we brought it to the top brokers when we had that trip. And, that was a real pivotal point for the birth of Mortgage Plus, because we came to our top broker partners and said, we have this challenge. Here's a sketch of what we think is the solution. And, the brokers in the room at that trip, you were there, came together around that, gave us some really good advice on how to put the finishing touches on the design. And they supported. I don't even know if support's the right word. Like they embraced it and they said, yeah, we can do this.
It was a total buy-in from my end. And again, you go to those types of trips, you're typically around the same top people on all of these lender rewards types trips. So you get to know your competition pretty intently on these trips, and more so you build relationships. And the takeaway from just the table I was sitting at and then ongoing relationships and discussions that we had around this, it was total buy-in. We felt like we're almost a part of the delivery of it and crafting it. Like you guys had your concept, your strategy, that was all you, but you made us feel like we are a part of the idea.
Totally.
I think that's just kind of like the 101 to get buy-in from your partners, is make them feel like they were a part of the decision.
Just to that point though, when you delivered that messaging to the brokers on that trip, did you go to the broker market before and say, hey, this is what we're looking to do, and just kind of craft it out from there? Like, were you looking for broker feedback the whole time? Like, how did you kind of come up to the strategy?
I think in Austin was that time, right? Like we had done our homework, we'd done our analysis. I think it was a straw dog, of a design, right? It didn't have all the finishing touches on it or anything like that, but we really wanted feedback on the design itself. Right? Is it too much friction? Is this doable? Do you see any roadblocks and things like that? But also gaining the buy-in on the execution, because there's a lot of great ideas, that don't really come to fruition because you don't get the buy-in and you don't get that, what turned out to be excellent execution, right? And led by the broker channel for sure.
In my career, I've never seen something like that implemented that way. It's typically, hey, here we have this solution or this cashback promo or whatever it is, and it just comes and sell it, and it doesn't really get sold.
Right.
I think just the delivery of it was perfect. A lot of other partners and lenders can learn from that type of implementation. So I really appreciated it. And also the honesty of, at the time, things weren't great. You were pulling back. Just the honesty of like, hey, this is some serious stuff. We need to fix this, like, to basically survive, was how the message was delivered to us, is like, hey, you're a big partner to us, like from your lens to the brokers. And we've obviously felt the same way, just given, the volume and the stats that I was talking about earlier. We wanted to make sure you guys are successful so we can be successful to continue to work with you. And I think every broker had that same mindset in that room.
And it's a perfect example of the SMA model in action, right? Like, when you have a model like that, that's built on, relationships, it's not just a transactional business. It's actually relationships that you can do stuff like this.
Yeah,
and I think this is a great example of that.
So it's obviously here to stay because it's been a huge success.
Definitely here to stay.
Yeah. Any like upcoming improvements? I'm sure you're constantly looking at how to make things better. Not that it needs to be better, but I'm sure there's ways to go deeper here. Is that stuff you're continuing to look at?
Yeah, for sure. I think what we're focused on now is, as far as the basic setup of it, seems like the design of it, yes, pretty good. But I think we're happy with that. The opportunities are on, reducing the friction, in the process, right? Like getting the products open for the customer seamlessly, low friction for the brokers and the customers, right? So more digital, for example, that type of thing, to get those products open quickly, reduce the amount of handoffs that are going on. And then I would say the second thing is probably, focusing on that excellent handoff of the customer from the broker to the branch, where they're going to have a relationship that's good for the customer and good for the broker too. And I think more and more brokers are realizing that those things can absolutely coexist, and as long as the customer's happy, they're both of our customers. We're really trying to bring that part of it home.
So more so like an efficiency, the tasks that have to be done behind the scenes from a broker's lens. I would imagine that's constantly being looked at. Like one thing I always think about is just when I was brokering, and even today when running the brokerage, I noticed the highest quality clients that we worked with were placed at Scotia. And that meant professionals, high net worth individuals that maybe are looking for a bit of a increased service from, let's say, a private banking type of a expectation. Just looking at that type of a client, is there somewhere we can go deeper with like a mortgage plus type of strategy with those higher net worth clients and getting more of a connection?
Definitely. I think that's probably a subset of what I was talking about, a good handoff, right? If it is that type of customer who needs more of a private banking, like more wealth management focused type of relationship, like we definitely have that in the bank, obviously. And that's a great example of an area that we should and planning to focus on.
And the reason I bring that up, going back to that rewards trip, we were asked to raise hands like, where's our business bank account? And is it with Scotia or is it with any lender in the channel? And it was pretty shocking to see how many people raised their hands that had a business bank account at an institution that's not in the channel. And it was an interesting way to kind of frame, like, why wouldn't you support the lenders that are supporting you in the channel? Like, why would your business bank account be at another institution that's not, a lender that's supporting us? It wasn't framed exactly like that, but it just made you think, like, yeah, why wouldn't my mortgage be with Scotia? Why wouldn't my personal bank account, like, if they're my biggest partner, why wouldn't I partner all in? And it was at that moment where I took my personal mortgage from a lender that wasn't in the channel, and it's now with Scotia. And, I've been able to now experience and own, the service. And I've had an incredible service when it comes to my banking from that point forward. And that is where I then started to think more deeper about, hey, we're not just mortgage brokers, mortgage professionals, mortgage agents, whatever you call yourself in your province. And it started to make me think more about how can we, go deeper. And ultimately, it's just a better client experience. And if you can show that trust in the relationship with the bank, that's only going to show trust with your client and why you're suggesting it.
Yeah. If you've lived it yourself, it's a lot easier to help your customer down the same path, for sure. Yeah. And thanks for your business, by the way.
Absolutely. Hey everyone, Dean here. Quick timeout from the episode to share with you the ABW Tuesday Mortgage Memo, your weekly market highlights sent directly to your inbox every Tuesday. This is certainly one you're not going to want to miss, so make sure to sign up now. You can do so with a link in the show notes, or you can head to joinabw.ca and sign up there. This is a high-level summary of market developments, regulatory updates, and housing trends every Tuesday. So hope you enjoy it, and back to the show. Okay, so maybe shifting gears here a bit, I wanted to get into just the pricing complexity and the market dynamics, because if we go back earlier in this year, rates were up and down every single day. It was very difficult to effectively tell your client what rate to expect.
Yep.
And if you think of a mortgage broker trying to pre-approve a client and give them a price point to go shopping, it was very difficult. It caused a lot of frustration. We had a lot of our agents calling us pretty much every day, like, hey, I found out broker Joe got this rate and I'm getting this rate. And it was like, well, he got that rate quoted to him 3 days ago and yours is today. So just getting into that, because you did a presentation in Quebec City, that was very enlightening for me, very helpful. So I wouldn't mind just jumping into that and how that all works.
Set the stage for that a little bit. I think, the best way to understand pricing is to start with understanding, how banks think about their cost of funds. And so that's what I wanted to sort of go through a little bit here. Banks, unlike, some other participants in the market, like, they have a lot of different sources of funding. Right? They have deposits, they have covered bonds, they have the NHA MBS program, securitization programs, and they have their own ability to issue bonds to raise funds. So there's lots of different sources of funding. And they also have a lot of different lending that they do, right? So, all banks have to have some way of bringing order to the cost of funds and transferring that, and they call it transfer pricing. That's really what underpins people like me trying to run pricing and profitability of the portfolio. It sort of starts with that, the cost of funds, which is based on a transfer pricing methodology. So I wanted to kind of share a bit of the construct of that, kind of how that works, and put that in the context of the year that we've just been through. Hopefully people will understand a little bit better, what's going on behind the scenes that is causing those pricing experience that you're sort of feeling as a broker and as customers out there in the market, right? So a lot of people talk about, banks' cost of funds. They say, watch the bond market. And that's true. The bank's cost of funds is based on the bond market. And that's the blue line here. We call it the base rate. It's not exactly the bond market. It's a derivative of the bond market. It tracks the bond market. And that's one component of our cost of funds. And people can see that if they follow the bond market, they can get an idea for how this is moving around. The part on the bottom here, the black line, is the second part of the cost of funds, which we call liquidity premium. Most banks have something similar to this, by the way. The point is that there's two components. And the liquidity premium is something that represents the additional risk that the market, attributes to a bank raising funds in a market versus, let's say, the government of Canada right? Which is more the blue line. So the black line is that additional, say, liquidity premium. Some people call it different things, risk premium, whatever. That's what's represented by this black line at the bottom here. And when you add the two together, you get the red line on the right-hand side here, which is the total overall cost of funds. A couple things just to call out. The blue line is, like I say, the base rate. The market-based rate is hedgeable. So when banks do hedging, they're protecting the blue line. When in a 120-day rate commitment environment, it's very important if you're making a rate commitment today, by the time that deal funds, you need to be protected that your cost of funds is still going to be the same or close to the same as when you made that rate commitment. Otherwise, your profitability doesn't take much for it to go unfavorable. We have people in Treasury that do that hedging, and it's an important part of every lender's operation because of that 120-day rate commitment, right? And there's a cost to hedging, which is built in.
Yeah.
And the cost of it depends on the market, the volatility of the market, the direction that it's going, things like that. So it's not a fixed number. It moves around too. The black line's not hedgeable. So this is an important thing is, the black line is the liquidity premium component, if you will, of the cost of funds is not hedgeable. So there's an embedded risk in there that in that 120-day rate commitment period, if that liquidity premium goes up, your margin gets squeezed and vice versa, right? The reason I mention that is because if you look at, and we'll talk about some of these spikes a little bit as we go through this, but if we look at the red line, that's the overall cost of funds since the beginning of the fiscal year. So we're going back to last November, and you look at, first of all, the volatility. We had a very volatile year. I went back and I took the absolute value of rate movements on a daily basis and added them up, right? The total rate movement in the year was 1,000 basis points.
Holy smokes.
And you think of a 250 business day year, that's like 4 basis points a day in any direction, right? Bank of Canada moved their rate 150 basis points.
Yeah.
So just to put it into context, right? Bank of Canada moved 150. Our cost of funds moved up and down 1,000.
It's insane.
Right? So
looks like my EKG.
Mine too. Mine too. And if you look at some of these spikes in the red graph there, the first one there in the last fall, was Trump getting elected. And you can see how the market reacted to that. Cost of funds went up. If you look back on the left-hand side to see where it came from the blue line, the bond market, not so much the black line. So bank credit didn't really react, but the bond market did, right? If you look at the next spike there, that was in January, that was Trump's inauguration. But look at the spike up.
Yeah.
Same thing. If you go back over here, you see the blue line, it came from the bond market a little bit, but not so much in liquidity premiums, right? And then you look forward to April, the next big spike there, that was Trump's Liberation Day, as he called it, beginning of April.
Yeah.
Came out with the tariffs and, some of the Canada, commentary, 51st state and all those types of things. On that one, the bond market surprisingly didn't really react that much, but look what happened to liquidity premiums. Liquidity premiums spiked way up in April. And remember, they're not hedgeable.
Yeah.
So that was a period of time where all banks were getting squeezed on their commitments that they had in their pipeline, and stuff that was funding around that time, was under quite a bit of pressure.
Clearly.
Right?
Yeah.
Not hedgeable pressure, right? And then if you look after that, things kind of start to settle down, right? If I go back to that 1,000 basis points of volatility, 2/3 of that happened in the first half of the year. The second half of the year, only 1/3, right? So, and you can see in the red line, more stability, markets getting more used to the trade rhetoric, and you talk about that, and, not hanging on every announcement in the media type of thing, like what was happening earlier. And so we've seen some settling down, and then, more recently declining coming from the bond market. Again, liquidity premiums have been pretty stable. There's no kind of perceived risk of banks, being any more risky, Canadian banks, like those type of things that you would see in elevated liquidity premiums. We've seen that settle down. And so sort of the last couple of months, we've seen the overall cost of funds come down, a couple of central bank rate cuts, in there too. So I wanted to sort of give people a bit of a sense of what's in behind the cost of funds, how volatile it's been. So going back to your point about the craziness at the beginning of the year, like this was why, right? Like we're trying to manage like all the volatility that was going on literally a daily basis. And it was tough for everybody to manage through that.
When I think about pricing, and I would say most mortgage brokers in the country think bond market, where's the bond at today? And they think for some reason, things are going to change. And in some cases that is the case, right? But just understanding this liquidity premium, the risk, and the fact that it's not hedgeable, I don't think many people, especially listening to your presentation, really knew that.
And they don't always move in the same direction.
Yeah. And that was the biggest learning for me, is that they can go in opposite directions.
Right.
Very helpful information. I appreciate that.
Yeah, good. I'm glad.
I kind of wanted to look to wrap this up with retention and renewal strategy, because there's a big component to that, and the service that Scotia provides in that area, I think is significant. It's different than what our other lender partners provide. Just goes back to the relationship and maintaining a good client experience, and especially in the renewal wave that we're in right now. Banks, from a competition perspective that we don't work with, have been very aggressive in this area, and the ability to just re-enhance the client relationship, client experience with the bank that we've recommended, I think is significant. And knowing what goes into this area from a mortgage broker's lens, I think would be very helpful to understand, how you can leverage this to just ultimately have a better client experience from the broker side.
You said it. I mean, the maturity wave has really ramped up in the last couple of years. I think what's happening is, the market used to be predominantly 5-year maturities. So you get that rolling 5-year and everything's kind of stable. But what started to happen when interest rates went up is people started to go shorter terms, let's say 3-year. So now what we're seeing happening is the 3-year are piling up on the 5-year.
Yeah.
Right. And you're getting these almost like double cohort type of maturity in like this past year. And then even going into next year, we're still looking at really big maturity cohorts, and it's in the media, people talking about it. At least interest rates have come down a bit, so it's not as big of a payment shock, but it's still a lot of volume of maturities. So, there's a lot of opportunities there for customers to revisit where they want to have their mortgage. It's a repricing opportunity. There may or may not be a need for some new money, maybe a refi, type of thing. So there's all different scenarios going on in there, and obviously retention is a huge priority for all banks, anybody in the mortgage business, quite frankly. And so, to maintain that portfolio growth. So, we've put some new things into motion. And one thing is a dedicated mortgage renewal specialist role. We've recognized that, with renewals, same as what we were talking about earlier with originations, you really need a specialist, right? A renewal is also a complex thing, anything to do with a mortgage. So, that renewal specialist role, we've created it. We tried it out. We've since doubled it in size. So we now have a substantial group of people doing specialized renewals.
When was that role implemented? How long ago?
Came out in 2024, July, and we doubled it this year.
Wow.
Yeah.
Wow.
This was to kind of help with the capacity of the branches doing the renewals. We also have digital renewals. So we're trying to encourage people that are comfortable doing their renewal digitally to do that. Self-serve, it's pretty straightforward if you're comfortable. Not everybody is. And, for those people who want to talk to somebody, we've got this specialist role now. And then in December of last year, we rolled out a concierge service for brokers. So, there's a lot of situations where for a broker, for their customer to stay at Scotiabank is the right choice. We hope that's all the time, but we know it's maybe not all the time. But for all those times that it is, we put in this concierge service where the broker can feel confident that their customer is going to get an excellent level of service to renew their mortgage at Scotiabank. And then that good experience will reflect well on the broker who facilitated that, right? Like that's the idea of it. And so there's a pretty simple process for the broker to refer the customer in. The customer deals with Scotiabank. So it's not the broker handling it on the customer's behalf. The customer deals with Scotiabank. Our renewal specialist keeps the broker apprised of what's going on, lets the broker know when things are done. So there's that feedback loop, which brokers are really appreciating. And, the feedback has been good, very good from brokers who have tried it out. And, I think it's just, more and more comfort with it will drive more and more of that experience for where it makes sense for each individual customer.
And in a lot of cases, like just the refinance business hasn't been there for, a lot of reasons. Like maybe they're in a pretty decent rate currently compared to what they could get now. I think that's starting to change a bit. Or, just appreciation in their homes isn't, going up at the same rate it used to be. So there might not be the equity there. Qualification might just not be feasible. So it might just be a straight renewal in a lot of cases. And again, back to the competition, there might just not be an option to move that mortgage that makes sense to go through all those steps to just ultimately get a better rate. And I think just the overall experience and relationship with the bank is strong. So why not just, continue with that relationship, make it easy for the client? Because, going through a whole nother file and trying to move the mortgage, legal fees, all of that, right? And again, the documentation that you got to go through, it's not a great experience to go through a fresh new mortgage when you could just do a straight renewal and get it done very quickly and seamlessly. I think ultimately clients just appreciate that it's done quickly.
Yeah, and we realize that the broker's putting their reputation on the line a little bit by referring their customer into it, and they want it to go well.
Yeah.
Right? So we recognize that. And so when it goes well, the brokers also feel, okay, this is helping me, this is helping my customer. So
the last piece I'll touch on this is client midterm on, let's say, a 5-year fixed, maybe did that mortgage at a point where rates were kind of the highest in the last 2 years, and they're looking for a blend and extend type solution. Would that go through the same concierge service?
No.
Okay, that would be at the branch?
That would be at the branch. We don't have the virtual mortgage, like the concierge service is set up to deal with renewals at maturity.
Okay.
Which is for us 6 months prior to maturity.
Okay.
That's when we start our process. So there's lots of time. But yeah, something else like that, a blend and extend or that type of option would be through the bank.
Okay. The only reason I bring that up is it can actually really help a client. Yes, you're going back to 5 years in most of those cases, but it can really help just from a payment shock that maybe they had that, they've been maintaining. But if you can adjust that rate and add some more term, like it's not a bad idea and it's quite easy to do.
I think it's a great idea. I think it's something for us to explore. And, I think it's really just a matter of capacity right now. I mean, the renewal waves are so big, right? And so we're sort of trying to optimize, that specialist force as best we can to, prioritize the renewal waves. But, in an ideal world, other types of retention would be good areas to explore for the future.
Yeah. That's one piece that I just noticed recently, just in my own case and my own family. Got a mortgage 2.5 years ago, 2.5 years left in the term, and the blend and extend options are starting to look really good.
We've seen quite a bit of that activity. Yeah.
Okay, so just looking to wrap up here, future outlook, rates and real estate market, just your view on, the current and near-term outlook for rates, risk premiums, swap trends, just kind of all the stuff that we've talked about today.
I'm sticking with Scotia economics. The call at Scotia is we're at 2.25 with the overnight lending rate. It's at the bottom end of the so-called neutral range. So if your economy is healthy, you're not in a recession type of thing, 225 is kind of the bottom end. So we don't see any further rate cuts from the Bank of Canada. The call is for Bank of Canada overnight lending rate to actually start to go up later in 2026. What are the things? Like the reason for that is inflation. So the belief is that, inflation is already around 3%, yet the Bank of Canada has done 2 rate cuts. That illustrates the trickiness of the environment right now with, the big 3 things are, inflation, unemployment, and GDP, right? Those are the things to watch.
Yeah.
They kind of move in different directions, but when you get slow GDP and inflation at the same time, which is kind of where we are being brought on by tariffs to some extent, right? Then you get that really tricky situation of, do I lower interest rates even though inflation's not where I want it to be if you're the central bank, for example, right? So, I think that's the view of our economics team is that rates are going to start to go up next year. And that would be a healthy scenario, actually. If they were to go down, it would be a sign that things are not going well, right?
Yeah.
People need to realize, like, ultra low rates is not a good sign of the economy, right? Like, so yeah, I think that's the outlook for rates.
I wanted to mention this earlier, going through your graph. That must have been a very chaotic time for somebody like yourself in your role. Can you compare that to previous times in your career? And do you expect more of that type of activity going forward?
It's a good question. I mean, I look back and I say, like, to myself, when was the last time, things were normal?
Yeah. Yeah.
Right? I go back to 2019 as the last time things were normal. Like, what is normal?
Yeah.
But, because in 2020 we had the pandemic, interest rates kind of, went straight down in 2020, 2021. And then, 2022, the boomerang effect, rates started to rocket higher.
Yeah.
And it was that cause and effect, of what was an idiosyncratic thing. Like, it was an unusual thing, the pandemic, obviously, right? So, and then rates became super high to try to correct, going through 2023. Now we're starting to get into, the trade situation becoming a very, very big part of the economy. So that's potentially a new idiosyncratic thing that you don't have, in a normal. So, what is normal anymore? But like, I think, are things going to get back to, say, 2019 type of market? Yeah, I mean, I think so. Eventually you would think that the trade thing will settle down and we'll find a new normal. But, 2026, it's still going to be going on. So having said that, the housing market, you got the purchase side of the market. That's what everybody talks about in the media and whatever, like the purchases and listings and all that, right? That's been soft. Depends on where you are in the country, quite actually.
Yeah.
Like some parts of the country have been pretty robust, Alberta, Saskatchewan, Quebec, very solid markets. Atlantic, maybe starting to slow down a little bit in Atlantic, but, BC and Ontario have been the softest. But again, that's purchase side. And I think the thing that we all need to remember as being in the mortgage business, we're not in the home purchase business, maybe like a realtor, but we're in the mortgage business. So there's also switches and refinances and, renewals and all of that activity that's also part of the mortgage business. And that side of it has been super robust.
Yeah.
Right.
Yeah.
That's going to still be strong in 2026. So I think my message is sort of like, don't overly focus on the purchase side of the market. There's more to the mortgage market. I think it's going to be more of the same for 2026. 2025 was a good year. Yeah. And 2026 we see similar.
Yeah. I mean, I would agree with all that. I share the same outlook, and there's just so much opportunity, and it's just, the kind of continued reminder to continue to learn, educate, like, just looking at what we talked about today, brokers just needing to look beyond the bond market to, educate themselves. And, this is a perfect example of that. Our continued investment in education for our team and brokers in the industry, Scotiabank's long-term investment in just your frictionless broker experiences. You guys are always trying to be better, which is all we could ever ask for. And I thank you for your time today and just, willing to share this type of stuff. I know it's not common for a bank to go this deep with the broker channel and just doing this type of education. So I appreciate it very much. And thank you for your time.
We're on record that this was your very first podcast.
It was. I hope I did all right.
And it was excellent.
Yeah. Thank you.
Thank you for your time.
Thank you so much for the time too. Thanks for the opportunity.
Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2025. This remarkable organization addresses a hidden hunger issue many are unaware of in British Columbia. While school districts provide meals during school hours, numerous children face food scarcity at home, particularly during the weekends. Backpack Buddies steps in to support these vulnerable children, ensuring they have easy to prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, Thank you for listening, and see you on the next one.